Right, so welcome back to the afternoon schedule. So this is, we got three set of talks and then a panel, and it's all going to be on DeFi. And we've got Gary Yang from CICADA Finance, and he's going to talk to us keynote on tokenomics. So welcome, Gary. Thank you.
Thanks. All right, thank you. So let's begin. Today our topic is about asset management, on-chain asset management. And we call this the second growth curve. Why it's the second growth curve is because before this year, actually, we call that the first growth curve based on meme, narrative, and consensus. Why is it called consensus? Because you have to build up the consensus first and then to lift up the price of the token market, right? And now this year is totally different. It's about many connections between the TradFi and the DeFi together. So actually there will be real yield asset behind all of these tokens. It could be stock market, could be traditional quant fund, or any kind of a yield-bearing asset. So this is what we call the second growth curve. The dynamic is totally different. Okay, now what we are going to do is build up this kind of platform. All right. I'm sorry, it doesn't work. Okay. Okay. And for me, actually, I've been an investor myself for 15 years. I'm a Web 1 investor, Web 2 investor, and been rug pulled many times. So now it's a Web 3 investor, also been rug pulled many times. I've invested, Multicoin is pretty good. I've invested many of the funds, Multicoin, OSG, Standard Crypto, 15 funds, and many of the DeFi companies. And I've got plenty experience of being rug pulled. And I don't mean that actually this fund is not good. They're okay, but actually it's too far away from the token, from the capital. So I decided to jump into the market ourselves. From venture capital, become venture building. So we jump into the market and build up this on-chain asset management. Half of our team, we have got 50 people around the world. Half of the team actually background is the traditional asset management, doing the family office and the venture capital things. And the other half actually is based on smart contract, tokenomics design, technology, product design, all of these things. So it's kind of a very hybrid company. And that is what we call is the on-chain asset management. Oh, it works. Thank you. So this is my background. My fund is Eureka. I invest in Multicoin, many of the funds. And my company, VC company is called SKALE Capital, is very active in Asia. I invest 120 portfolios companies. Mostly Web 2, but after COVID-19, mostly it's Web 3, DeFi companies. And my partner's company is Stratify Capital. So this is our background. And now we're going to put many of different kind of asset and mirror them on-chain. And this as underlying asset, tokenize many of the, to pay attention, is a liquid asset. You cannot make every RWA to on-chain asset. No, you cannot do that because there's no fair value, no liquid, and no consensus at all. So many people think about RWA, try to put many RWA to the token markets. No, you cannot, because there's no liquidity. No one will do the liquidity provider. There's no transactions. No one will help you do the transaction and the exchange. So liquid asset is very important. You have to link together the liquid capital, liquid funds with liquid asset. And you try to do some of the liquidity engineer. What is a liquidity engineer? It's try to put something T+1 year to T+1 day. It's very difficult. You can see that Ondo and Lucina have done this. How they are doing this? It's to build up a small pool, 3% of the capital to make T+0. And then to make the subscription and redemption from 1 quarter to 1 week. This is the competition for this year. They try to do some of the liquidity less than 1 week. Then it's liquid asset. So not all of the RWA is liquid asset, especially for real estate, for artworks. It's very hard for you to do the liquid asset behind it. But quant fund, you can do that because quant fund, actually, many of the quant fund strategy can do T+1. But the settlement is very complicated. You have to make the settlement very professional. Then you can make it a liquid asset RWA. All right. What is the difference between traditional Web 2 investment and Web 3 investment? I built up this one. And then the Web 2 investment is to build up the expectation realization. What does it mean? It means that you have to build the value first, make the technology, build up the product, to push into the market, go to market, and then the secondary market. So it's a positive. It's this way. It's an expectation realization. Web3 is different. Web3, the most important thing is liquidity comes the first. So day one, you have got liquidity. You can tokenize a thing. And then you have got the liquidity first, then finance, then consensus, then build up the market and product. So it's a reversed process. It's what we call counter expectation. So this is the difference between Web 2 and Web 3. All right. So in the last 16 years, actually from 2009 to 2024, actually it's 15 and 16 years. 16 years means 4 cycles. And this cycle actually built up the blockchain, crypto, and Web 3. But there's still not enough real thing, real underlying asset, real backup things over there. So we call this first growth curve. What does it mean? Its first growth curve actually is really similar to preaching. Preaching is say that you have got a narrative, you have got expectation, and then you preach in the market. You say the narrative, and then you build up the price. And if there is no value behind it, then it's Ponzi, right? So this is the first growth curve. Now it is different. It is a second growth curve. You have to put the real yield. After preaching for a century, you have to do something real, right? So this is about crypto. You have to put a real yield and real application behind what you're doing. So this is the second growth curve of the crypto, which means Ondo put T-bill behind it. You can see that from this quarter, Ondo tried to put some of the stock market behind its Ondo, behind its market, right? Ethena is doing the, before it's a single funding rate strategy, and now try to do more strategies over there. And Figure is put a loan market. And you know that Maple, I talked to Maple CEO last week in Singapore. Before, actually 2 years ago, Maple is trying to do asset management. 1 year ago, Maple is doing the, to try to put T-bill and treasury behind it. This year, behind 2 billion TVL and AUM of Maple, actually it's all about loan market. So it's real RWA. And then this kind of real yield and real application is the real, what do we call this, a second growth curve, which is very important. And we're now doing that. And yeah, for first growth curve, very big problem is only preaching, but no real yield asset. It's a Ponzi game. So everyone knows about that. And for traditional narrative, it cannot last long. So this is the problem. I wrote many articles in the market, for example, like a zero-sum problem. And there's a 5 big giant around a table, which is CEX, lending protocol, market making, projects, big whales, VC capital, and the real-time investor. And this is a zero-sum game in the last cycles. So it cannot last long. You have to put more real asset behind it. So why RWA? In last year, actually, most of the people actually say that RWA, it's a prehistoric word. It's too traditional. But this year is totally different. Everybody knows that RWA is really important because you have to put asset behind it. So RWA and the rise of the stablecoin economy is pretty important. So after the election from last November, this year actually totally changed, especially after the meme wave, because meme wave is the milestone and it's the terminal of the first growth curve. And after that, people realize actually crypto is a new generation decentralized version of financial system. And we have to build up something real behind it. So everything on chain, from T-bill, from different kind of strategies, quant strategies, and also different kind of asset, now RWA and stock market, right? So this is about all of the, what do we call this, crossing the chasm, is to do the second growth curve. And this year, there's a very apparent turning point, is the Genius Act. The Genius Act actually is really genius. I wrote articles about details how to explain Genius Act. Genius Act actually, the Senate and House, and also the federal, think through one thing. What is that? Actually, to control a market, financial market, currency, or transaction, to control that is not control the issuance and settlement anymore. Because in the last 1 century, or even more, To control a financial market is to control the currency itself. So after COVID-19, there are many countries try to eliminate it, discard, and not use US dollar transactions, and try not use SWIFT or any kind of this. It's because the settlement consensus is broken. And many countries try to build up their own CBDC. It's actually used the traditional way to build up the hurdle or great wall to prevent others to come in. Actually, it is not the way to do the consensus. It is not the way that you can control some of the economy. No, it is not. It's wrong. And but Genius Act actually is very genius because they understand that the only thing is the pricing power. For example, like it's a Starbucks. Starbucks is a coffee, right? Coffee $5, and if you say that it's okay, it's a $7 Singapore dollar or 50 renminbi, actually nobody care. It's because the occupation is only 2%. And the US dollar, because why everyone use that? Because they have got consensus of a pricing power. Once you say that it's $5, everyone know what it is. So consensus actually is the very core part of a currency, of a financial part, of financial system. So if you go to Nashville last year and Vegas this year and listen very detailed about what one said, although it's very radical, but actually it's very detailed, say that everyone can print shadow money after Genius Act. If the shadow money is outside America, and this is not the money, is not the currency in the permission list. But if you inside and actually follow the law for Genius Act, and then it will be accepted, means that the M2 is no longer the M2 federal gut. The M2 actually become bigger and bigger. But if the M2 be doubled or tripled or 10 times, actually what will happen means that M2 is no longer the thing that evaluate the market. And the most important is the consensus. For example, like you've got USDT, got USDC, got USD1 or USDE. USDE is the Ecina USD, right? The thing is that how much pricing power consensus you've got. For example, like a USD1, I'll talk to their foundation. If they're not doing enough marketing things, just use a fame and to let everyone to play that. It is not enough because you have to build up the market, and to drive the market, you have not enough consensus, then it is not enough. So all of these stable coins actually is no longer the understanding of what is the amount, what is the M2. No, not that way. The thing is that issuance is not important. Whether you can have got a chain, on the chain you've got a smart contract and you can print the money yourself. I can do smart contract version of a US dollar Gary. No, nobody will use that because there's no enough consensus, but I can do that. But if you can enough power to enlarge the market, to expand the market and let US dollar Gary, everyone can use that, then you have got consensus. You can compare with the USDC and USDT. So issuance and settlement become not that kind of important. But the pricing power by Web3 version, which means that you build up the consensus, is very important. So this is the thing that's real different from before. And this is the thing what actually internally, essentially different from the traditional finance. So I mean that I've been an investor, veteran investor for like 15 years. I realized this time is a totally paradigm shift. Means that you cannot follow the traditional macroeconomy, and you have to build up the new understanding of what it is. Everyone can print money, but you have to build up the pricing power of your money. This is what exactly Ecina is doing. And a huge market opportunity. After the Genius Act and the Project Crypto, there will be a very big market. Before, actually, it's only the BTC market. Many people, many friends say that BTC can go to $1 million US, maybe in 10 years. But that only actually is from 2 trillion to 20 trillion. It's not enough big. But this one is bigger. It's on-chain asset management, and it's a on-chain decentralized, or you can see Ondo on the website is said it's open economy, or Ecina call it the digital economy, or internet version, Web3 internet version economy. That market is pretty big, and it's more than 100 trillion over there, which means actually we'll try to overturn the traditional economy over there. So this is the market we target, and we base this understanding, and we're doing the business. And for us, actually, is to build up the protocol to overall and actually to mirror all of these different kind of asset. For example, like stablecoin, non-stablecoin asset, liquid, high liquid or low liquid, different kind of asset to our protocol. And to link together the liquid funds and the liquid asset. And we will got a token, and to our platform token and asset token will have got a linkage. You know that UNDO and USDY and OUSG, there's still no linkage. And for Ecina, ENA, and their tokens, USD and SDR USD, have got some kind of linkage by their points. So this is actually generally build up the linkage. This is the trend of the asset management. And we invent a word that is called layer yields. And you can see just for the bottom layer is a traditional family office and traditional asset management, which means that you have got a IC. It's an investment conference, right? And then you have got a different strategies and get an investment. And so this is traditional asset management. And up layer actually is a DeFi. In the last 4-year cycle, many of the BTC Fi and DeFi do that to build up a narrative and then to link together with different of ecosystem, like a Solana, like a Sui, like Say, like a Monad, like any different kind of that. And they have got a mutual grants. You can see that from the last cycle, most of their returns and most of their actually investment returns is being granted by different kind of platforms. Actually, it's an advertisement fee, right? And if you know that Sui Foundation is very actually they have made a lot of investment fundraising, and then they can give you more airdrop and grants. So in the last 4-year cycle, and many of the DeFi protocols, they provide earnings and provide different kind of returns by the grants. And the grants actually is from different kind of ecosystem, like a blockchain, like a wallets, like exchanges, and they give you all of these grants. So this way, we call this Web3 native version of return and earnings, including Pendle. What is Pendle doing? What is Pendle doing? Actually, Pendle just make a mechanism to divide the principal and the interest, and then you've got a way to gamble the interest. So that is PT and YT. So Pendle have got a very big marketplace, and all of this marketplace inside the asset inside the Pendle actually is by this way. It's not by traditional way. And now what we are doing for the second growth curve is merge this together. Merge this together means that there's underlying asset over there, and there's Web3 composability and derivative over there, and to merge this together. So it's up layer and bottom layer. And for detail, what we are doing is to doing the financial engineer. Financial engineer kind of is very professional in Web2 and traditional finance. But in Web3, it means something else. Once it's a yield engineering, just like Pendle doing, PT and the YT, and try to split all of the YT, make the YT composability and derivative. And the liquid engineer, liquidity engineer means that you have to create the liquidity. I've been an investor very long time. The very big headache thing is that many of the assets, actually, there's no way to exit. There are no ways to get return. If there is no secondary market, many of the asset is not liquid. You have to talk with some of the investors and then sell to them. And it is OTC market, very difficult. But in Web3, you have to create the liquidity pool and different kind of a liquidity engineer. For example, like you have to make the alignment with the asset itself and to calculate the NAV and the settlement every week and then to build up this settlement. And then to build a mechanism for how make the redemption things. So this is about liquidity engineer. And all of the detail we are doing is to yield engineer and liquidity engineer and play this like a Lego. And to put it together like a Lego, it's a Web3 engineer. So it makes a Web3 version of DeFi with real yield underlying asset. And our value actually separate to 5 layers. And the fundamental layer actually is an asset management layer, which means that it's traditional asset management, but by different angles. For example, like the biggest part for asset for now for us is a quant strategy. It's similar to Ecina, but that is a single strategy. We are multi-strategy over there. And yield bearing for mining and some of the hash file, what is actually driven by calculations, by computings. And for this part, actually, this is definitely the trend for next year. It's a long fi supply chain fi. Long fi, I've mentioned about that. There are many companies actually have already do that, like a Figure, like a Maple, like many of the company here. And supply chain fi definitely is the big trend over there. We can put letter of credit, acceptance of bill as a different kind of asset, tokenize them, and put into the market. And we can see that in New York, in Hong Kong, many companies try to do that. Yeah. And also the other kind of RWAs. Maybe some of this is a low liquid RWA for now, but after liquidity engineer can be high liquid RWA over there. And the settlement layer actually is very complicated, which is a very hard work, detailed work for us. And then the product layer, bring it to the protocol and make sure it can be composed into other protocols. We can have the connection and to support different kind of a derivative. And then it's the product layer, and then it's the application layer. And then especially after the project crypto, after August, and we can see that the combination together with the traditional market, especially for security company and some of the traditional finance company, actually there are more and more opportunity can cooperate with them. So application layer, TradFi markets is very important. And we can see that TradFi market actually will try to change their mindset and to merge together with this kind of the second growth curve version of a DeFi market. So it is very important. This is about the value layering. And what we have done. For this Q3, actually, we launched our CICADA platform and got oversubscribed in July, actually. And we are the top 2 project for now on USD1. And also, there's more than 1,000 ambassadors apply for us. And we have got a lot of collaborators, different collaborators. And for this quarter, actually, for one thing, actually, we got listed on NASDAQ. And from the other side, there are more and more different kind of asset actually work together with us, including the quant strategy. And also, what I mentioned is about loan fi and the supply chain fi. All right, so this is what we are doing. And we can see very clearly there are different kind of flywheel in this mechanism. The trend is very apparent. At first, actually, it's Web3 and Web2. The first flywheel actually is after our TGE, we connect with the traditional market, especially for Q3, we can have the listed dividend. So that is the first flywheel. And then also the RWA, then we can have, with more and more asset, actually we'll try to use this kind of a DeFi version and tokenize their asset to the DeFi market, make the liquidity actually more smooth compared with the traditional market. And then there will be mass adoption effect. And so we're pretty sure actually this trend is very apparent. And you can see if you go to New York, and then this trend is more apparent over there. All right. There are many difficulties inside, especially for compliance and security. In different districts and different countries, for now, actually the security, the law system and the compliance, the policy, and very detailed about how to make this tokenization is totally different. For example, in Singapore it's the MAS controls 3 departments, and each department, one is a security, one is tokenized, and the other is payment. And in Hong Kong, it's different. Hong Kong is similar to the US, and each of the lines is independent. I mean, for the payment of the currency, for the tokenization and securitization. Oh, for this part, actually, there are 2 direction. If you put token onto the traditional market, we call this the securitization, like a DAT, like MicroStrategy and many of the stock market is doing now in New York. And in the opposite way, we call this the tokenization. Means that tokenization is what we are doing now, is try to put different kind of asset, make it liquid on DeFi markets, and then to generate token, and then you can build them as a tokenized version of liquid asset, which is tokenization process. So with this, all of this, actually, you have to back on a compliance standard. And now, actually, we try to merge some of the policies together from Asian and the US and to build up this new compliance system. Okay, at the end, this is the trend, what we are doing for now. And after the first four cycles for first growth curve, and then we have got a second growth curve. And definitely 2025 is exactly the turning point for the paradigm shift because we have got a new market over there. And people actually are tired of, kind of tired of the traditional narrative way. And we're now searching for more solid asset behind the real trend. All right, that is all. And we'd like to contact you more and talk about RWA. Thank you.
Thank you, thank you. Next, we have Matthew from ZetaChain talking about stablecoin regulation.
All right, thank you very much.
Is going to be doing an expert session in 5 minutes in the boardroom on scaffold and some technical stuff. So just expert session in the boardroom. Obviously, Matthew here.
Can you explain the technical side of it? What it was?
It's going to be building, using scaffold to build the stablecoin implementation, but more technical. Good stuff.
All right. Thank you everyone for being here. Just quick show of hands. How many of you guys feel like you guys are experts in stablecoins? You know all about everything that's going on in the world today, in the world of stablecoins. Okay. How many of you guys are familiar with USDC, USDT? Okay, we're gonna mix it between 101 and 102. That's good. Welcome everyone. My name is Matt. I am the ecosystem lead at ZetaChain. For those of you who don't know, ZetaChain is a layer 1 blockchain where you can build on us. However, you're not siloed to just one chain. You are automatically deployed on all the other blockchains that we're connected with. So, for example, you are deployed on Ethereum, you are deployed on Polygon, Base, and not just all the EVMs, Solana, Ton, Sui, and you even have a connection to Bitcoin. So you can have tokens move freely throughout ZetaChain, and you can use whatever you want with complete chain abstraction. So with that being said, how do stablecoins work? How do they play into this? Well, as we all know, USDC, USDT are the big players. All it really means to be a stablecoin is that you are pegged one-to-one with a fiat currency. So in the case of USDC, USDT, it's one-to-one with the US dollar. So right now, as it stands, the current stablecoin market cap is about 160 billion, and that's probably already wrong because it's growing so quickly. This is really starting to take off as an industry. It's really got its hot moment right now. This right here is a chart. I highly encourage you all to check out Visa's Allium. They have a bunch of free analytics tools to be able to look at what's going on right now in the stablecoin place. I wish they covered some of the newer ones like USD1. And even, I don't think USDE is on here either. It's not. So it'd be nice if they covered that as well. But you can go to their website, take a look at what's going on in the stablecoin world and where the transactions are happening. Highly encourage it. But as you can see here, this is what the stablecoin space looks like right now over the past few years. We start out in 2020 when we had some starting to get some uptake, and then we hit 2022 where we had a nice high, and then some things happened. I don't think we need to go into it too much. We saw a little bit of a decline, but now as we've started to get a little bit more regulatory assurance, we started to see some uptake, and now we're hitting all-time highs. And just wanted to point out here, this is all the centralized exchanges that are going on. And then right here is decentralized. So as we can see, the decentralized space is also having its moment. And one more thing before we move on, I just want you to think of a number. We heard 100 trillion. I'm going to throw out an even bigger number, $3.9 quadrillion. And we'll go on from there. Think about that number. Right now, as I said, USDC, USDT are the big players in this space. USDT has about 70% of the market share, and USDT has about 30% of that. And then I know the numbers don't quite add up, but USDE also has a pretty decent market share, around 10%. So of the space, USDT is the big one. USDE and some of these other newer stable coins are starting to make a little bit of headway. And then one more look at the transactions. These are the different stable coins by the different blockchains. As you can see, Solana has a pretty big lead in terms of transactions on chain. This is primarily because of a lot of the things that are happening on the chain, like meme coins, some of the NFTs, but primarily meme coins where people are buying in all the time. A lot of transactions happening, but that doesn't necessarily equate to large numbers in terms of volume. So just something to think about. So why is something that is just supposed to equal $1 so important? Well, because as we're seeing a lot of this digitization, it really hits home to what some of these established players in the space is so core to them, the banks. The US is really starting to get concerned that with all this stablecoin movement, how do we actually manage the US dollar? And as was seen in the last presentation, they're really starting to take things very seriously because this is also a play on currency, on how the dollar is the king moving forward into this crypto space. So in the past 4 years, we didn't necessarily see a lot of movement, but now with the new administration, we've seen quite a bit of action. The Genius Act was a big moment where it established a lot of rules for what a stablecoin actually is. However, what it did not really do is set who actually oversees all these stablecoins. So the Clarity Act was supposed to do that. It was supposed to set up who is actually the one who oversees all of it. That's still happening in Congress. When it decides to open up, we'll be able to see what's going on, but it is one of the top priorities that's still left to go for this administration this year. And then because of that, the Fed, we don't know if they have control. They're the ones who generally oversee banks. If these banks start to issue out their own stable coins, then the Fed should have some oversight, but how much? Right now, the SEC and CFTC also have conflicting territories. CFTC generally controls commodities. The Genius Act did help that because stable coins have been listed as property. They're not technically listed as money. So generally, the CFTC has a little bit more influence there. And then even the states have their own requirements. State by state, they have different requirements for how you market to the citizens in each state. So in a decentralized space where you're not necessarily focusing on one state or even one country, how do you manage that? And it's not just the US that's asking these questions. Around the world, every country is trying to wrestle with some of these issues. Some of them have taken a tougher stance, like Europe, where their MiCA Act requires so much in reserves for every stablecoin that's issued. Singapore and Hong Kong have sandboxes where they're allowing different issuers to play with stablecoins, but it's not really affecting. It's essentially like a test net for those. It's not necessarily a main net where it's out being traded in the wild. It's just kind of being tested and evaluated. Japan, they've had the conversations for years now, and it looks like they're starting to get close. They were supposed to issue out a stable coin any month, and that still looks like it's on track. We're just waiting for the final green light. Latin America and Africa, a bit more of a Wild West. And for them, that works out just fine. They don't really have established banks that they have to rival with. And a lot of their currencies are more focused on remittances. So these stable coins actually kind of help with that. So they're not necessarily as worried about the regulation. And around that, why? Why is this regulation so important? Well, number one, as I said, it's close to the banks. And by that, I mean, traditionally, when you send money through the banks, first of all, on the first day, the bank sends the money. It has to send a message to a bank saying, hey, I'm going to be sending you money. Can you make sure that you're going to accept it? So that's what SWIFT is for. I'm sure we've heard of that. It's just a messaging system. So then the bank has to say, yep, we're going to be ready. They're going to send the money over. The money gets over. It's finally settled in 2 to 3 days. And then you can actually get your money across. And then not only that, not only does it take time, it also costs money. Right now, if you do a wire, it's anywhere between $20 to $30 per transaction. Whereas with stable coins, when you send that token over, it's instant finality. And I don't know how many of you have played around on Base, Solana, ZetaChain. It's pennies to actually send stable coins across. So the cost to do business and the time to do business is severely flattened. That's why this is so important. So now we know why it's important. What are they so worried about? Why are they so worried about what happens? Well, because we've already seen some of the problems that these issuers can have when we're doing things that are untested and really don't have a way to really find out what's wrong until it actually happens. The perfect case is UST. How many are familiar with Do Kwon and what happened with UST? Okay, good number of you. So UST's setup as an algorithmic stablecoin was that they were going to say, okay, this is tied to $1, but if the price of the dollar goes down, then we're going to issue out this other token and buy up this stablecoin until it gets to the point of $1. It's a complete circular reference. If you plugged it into Excel spreadsheets, there would be an automatic red flag saying, hey, this function is just going to go around in a circle. It's actually not going to do anything. So no one actually looked at that until all of a sudden we had volatility in the markets and UST crashed. And that sent ripples throughout the markets. Another crisis that we also had to go through was with USDC. So USDC had a lot of their bank accounts, had a bank account tied to SVB, which collapsed. And so even though USDC had the funds, because it was in a bank that was no longer solvent, they couldn't actually reach those funds. So if all of a sudden you had a run on USDC, people wanting to cash out their USDC for the actual dollar, they may not be able to do so. And so these are all the questions that these regulators had to wrestle with. How do we actually manage this? So let's go real quick around the different designs of these stablecoins. With these stablecoins, the first one that comes to mind is fiat-backed. That's your USDC, that's your USDT. And all it is basically, here's my dollar, give me a stablecoin. And what they do with that dollar is then they go turn around and they buy US treasuries or other types of short-term assets. 99% of the time, it's short-term treasuries. USDT, a little more questionable because you don't necessarily see a lot of attestations of what is actually in the reserves of USDT. USDC, very transparent. They issue out reports every quarter saying, this is what we hold, this is exactly how much is in here, this is what we hold. Some of the issues with that, though, is you're trusting a centralized company to basically exist, and there's a lot of control that they can exert over the stablecoin. They can adjust it, they can change it however they see. You know, if they all of a sudden do something weird and they buy long-term treasuries trying to get more interest, they could become insolvent, and you run into problems with that. The next type of stablecoin that we have, something that hasn't really been in vogue as much anymore, but was for a while, is over-collateralized or crypto-collateralized tokens. This is like your DAI, they're now called SKY, where you basically put in more crypto, let's say, just for example, Bitcoin, you put in more than $1 worth of Bitcoin in order to receive $1. Why would you do that? A little bit more stability, especially if you think that there is some concerns that there's too much volatility, you can't handle it, you just want $1. With that, it's a little bit more censorship resistant because you are just interacting with a smart contract instead of a centralized entity. Everything is on the blockchain, so you can see exactly what happens. However, because it's over collateralized, you're not truly getting one-to-one, so there's a lot of loss with that. It's not as efficient. And then the new one on the block that has kind of come back from the grave after UST is synthetic or hybrid US tokens. So this would be your Athenas, your USDE. And what that is essentially I am giving you, in USDE's case, I'm giving you Ethereum. And with that Ethereum, I am going to turn around and stake it. And then not only am I going to stake it, I'm going to put a short on it. So in case it goes up, I benefit from the staking. However, if it goes down, I'm not losing everything because I'm also shorting it. That's what's called a delta neutral. So in case it goes up, nothing happens. If it goes down, nothing happens. It's not a bad strategy. You still earn yield on your staking. So the idea is that the return is a little bit better because the yield on these stable coins for staking is going to be more than the cost of shorting. The only problem with this is it's not really proven in a down market. This is still pretty new stuff. And the market can only be as big as the people willing to short these tokens. So there's always going to be a limit on how big this type of stablecoin can be. Yeah, that's basically what we covered here in the case study, where USDC is very trusted in the US because it's so transparent. You can see exactly what's in it. USDT is much more popular offshore in certain Asian countries, Africa. It's used a lot more on certain chains. Tron with USDT is I think it's like 60 or 70% of the market share is on Tron. Ethereum is up there too, but there's a lot more concentration of certain stable coins on different chains. And then Athena, as I said, 10% of the market share. It's starting to grow, but it's just not there yet. And on top of that, not only do we have these established players, but as I said, USDE is a newer player, and they're not the only ones in town. There are a lot of players that are now issuing stable coins based on some of these different ideas. Particularly the one that's been in a lot of news is Bridge, which got bought up by Stripe. So now anyone can be able to mint out their own stable coins and just kind of brand it as their own. Anchorage Digital was the first federally chartered crypto bank. So they've also been exploring issuance. And so that's a whole new world when you have just a crypto-backed bank issuing out their own stable coins. That's really different. Paxos has been around for a while, but they are now issuing stable coins for other players. PayPal was the first one that they really worked with for their own company branded stable coins. And then M0 is another one very similar to Bridge, where you can basically design your own stablecoin however you see fit and brand it as your own. So over the next decade, what are we actually looking at? How is this going to evolve? Well, I think you're going to see two different tracks emerge. The first one is you're going to go for more reliability, you're going to go for trust, and you're going to start bringing enterprise into stablecoin issuance, where you're going to have just fiat-backed stablecoins being able to move freely intercompany for cross-border payments. I think that's going to be a major step for the next 5-6 years. You're going to see a lot of, especially the larger ones, you've seen Google launch their own blockchain. I'm pretty certain that they're also going to issue out their own stablecoin and be able to move tokens on their stablecoin back and forth for their own company purposes. So something like that to think about for some of these other companies when you see news about them exploring crypto, exploring blockchains. And then you're also going to see more of like Athena with the synthetic stablecoins. As they issue out more yield, you're going to see more crypto native players go to this, as 99% of the time when we're on crypto and we're on DeFi dApps, we're all there for the yield. And since they can issue out more yield, they're going to have more demand. They're going to be rising more in power. And I think they're going to become a lot more popular in the future. So with that, what are we kind of, what can we take away with this? Well, for one, I think stablecoins are here to stay. There's no going back. They're only going to become more important as we move forward. And then How is it going to be regulated? I think it's going to become more and more like a bank. We're going to see rules and regulations to say who can issue out what, how much yield can there be, if there can be yield at all, which right now it looks like across the world, they're going to say no yield on issuance. Once it gets in the DeFi space and other places, that's a completely different story. And then how do we manage this risk? There's always going to be risk with any of these players because they're all tied back to centralized parties, unless it's like Athena, in which case you have your own risk with market issues. If you have problems with the markets that you're shorting in, problems getting enough people to take the other side for shorting, there's still going to be a lot of risk that needs to be factored in. And then I think we're going to see a lot more of these payment companies issuing out stablecoins because it's all very closely tied together. So when I mentioned something earlier with 3.9 quadrillion, that's currently the size of the foreign exchange markets out there in the world. It's the largest market out there. So if you're a stable coin, you're going to see USD stable coins. You're going to see Japanese yen stable coins, Korean won stable coins. Every country is going to have their own stable coin. They have to. Otherwise, they could be left in the dust, as was mentioned earlier. So we're still going to see a lot of this currency trading, and it's going to move faster. And you're not going to have as much tied down, being kept to the side as SWIFT is no longer needed. You don't need as much in reserves sitting in banks. You don't need to have it waiting around 2 to 3 days to be cleared. It's going to move faster. It's going to move quicker. So the foreign exchange market is really the ultimate market that all these stable coins are going after. Who wouldn't want a piece of 3.9 trillion or quadrillion dollars worth of market? So how does this factor in with ZetaChain? As I mentioned earlier, ZetaChain is an interoperable blockchain. So you can move all your stable coins from one chain to another because all these stable coins are not going to be tied down to one chain. It just can't. USDC has multiple, USDT has multiple chains. They're all going to have to move. And that's going to be part of the foreign exchange process as well. Each chain is going to have their own, each dollar or each stable coin is going to have their own blockchain. Each country is going to have their own blockchain. This is where ZetaChain is going to play. With that, I'd like to open the floor for questions. Oh, okay, sure. Yes, I am. So if you guys want to ask more questions, more detailed questions, happy to answer them there.
Yeah, break 30 and breakout at 3. He'll be in here talking about stablecoins. Thank you, Matthew. Thank you. Great talk. By the way, lots of questions. Lots of people were taking photos of your slides. Are you going to be able to make them available, folks?
Yeah, I don't really see a problem with that.
All right, great. So check with them at break.
Yay.
That way you actually be at home.
And next we have Jack from SKALE. Ready? He's going to be talking about proof of encryption.
Yeah. I have them up there. It's on the inside. Oh, okay. We good to? Yeah. I just have it.
Hello, how's everyone doing? All right. So hey, who here is from the Bay Area? All right. Anyone in town for SF Tech Week? All right. All right. I have to say, like every year at SF Tech Week, I think it gets more and more Web3 heavy. There's a ton of events this year. I feel like I'm at some big crypto conference. So good stuff, right? All right. Probably has something to do with this AI, crypto crossover, which driving a lot of innovation. So hey, I'm talking today about proof of encryption. Okay. Who here is interested in privacy, confidentiality with blockchain transactions? Okay, cool. I think it's a hot topic. It's kind of the next frontier. Today I will be talking. First, I'm going to give you a little background on SKALE, so you know who I am, what we're working on. We've been around for a long time. Kind of talk about why privacy matters. I think there's some obvious things, but also some non-obvious things, and also some things that are misunderstood. Also going to talk about proof of encryption, give a technical overview. What is this? How is this working? How does this function? How does it do all these things it's promising to do? Also going to talk about use cases. I think often in tech talks and blockchain talks, you get a lot of like tech, but not a lot of like, okay, well, how is this actually going to be utilized in the real world? And that's probably one of our main growth areas as an industry, is just getting these things more into the wild, more into use. There's so much innovation happening, but at some point you gotta deliver and reach the masses. Sorry, got a little clicker problem here. Okay, there we go. Okay, a little background on SKALE. So when people say, "Hey, I don't know what SKALE is," I say, "Well, we're top 5 of all blockchains and L2s and transaction volume and unique active wallets." Okay, so there's a lot happening in the ecosystem. This is primarily due to gaming. We have some huge game brands using SKALE. There's hundreds of games on SKALE. We're also deep in AI, decentralized social. You think about high volume, high throughput applications with lots of users. Okay, where cost matters. We also are known to build fast blockchains. So there's, I think, 16 chains in the SKALE network now, but Dartmouth did a study, like real world study, pinging these blockchain networks, and SKALE performed faster than in real life testing environment than Solana and Avalanche and some other, big well-known chains. That being said, we've been around since 2020. Okay. Back then, everything was, the holy grail was speed, cost, efficiency. We've kind of done that. And so as a project that's not new, we started in 2018. We're constantly still trying to evolve. And what we saw was a need for privacy. And we started hearing this from people. And it actually suited a lot of the dynamics and structure of the network. This is, my thoughts here. I'd love to, some people have probably some differing opinions depending on your lens of the industry. But back in 2015, it was all like, how do we get smart contracts out there? And we were like, it was about decentralization. It was about security. And, it was really like cypherpunks and early enthusiasts and like token traders. That was the market, right? Then 2020 came around. We had this next push, and it was like DeFi summer, Web3 apps. And it was, how do we get performance and costs down? We had CryptoKitties broke Ethereum in 2019, right? And so there was a race for performance. Now I see such a push with privacy, agentic enablement. Really, we have financial institution and enterprises. The stablecoin talk earlier, I think, is a good example too of like mass adoption in these industries, and I think more established players. Okay, so the barista test. The barista test is something. Actually, somebody told me this a few weeks ago. I was like, I'm gonna use that. So when you go buy a cup of coffee, let's say 2 years from now, we all have stable coins in our phones. Everybody. I mean, we might, but our friends who aren't crypto people are going to have them. If we live in that world and you buy a cup of coffee, these two guys, they look like pretty nice guys. Okay, like I intentionally grabbed this image, but do you want them to have your net worth, your core address, be able to track how much money you have? Like, probably not, right? So I think we need to live in a world where you can buy things with stablecoins and not expose your assets and what you own, and also do it in a way that's decentralized. Okay, so privacy is the next frontier. We want to support individual private transactions, like just being able to buy a cup of coffee. DeFi enablement. I'm going to talk about DeFi and how this plays a role in DeFi. Banking, payments, B2B adoption, agentic transactions. All of these categories can benefit massively from encryption and privacy. Real quick, what privacy isn't about, and I think it's often misunderstood, it's not this tornado cash world where we're trying to support bad actors to be able to obfuscate what they own, or help people avoid taxes, help people launder money. That's not the goal, okay? And there's so many real world business use cases. I've talked to someone the other day building a neobank that wants to use stablecoins, and they're going to launch this in Africa, and they say, we don't want, people aren't going to send money to their friend if their friend's going to be able to tell how much money is in their account. Like, we just need to have some elements of privacy. So I also want to say privacy and compliance aren't mutually exclusive, okay? And there's ways that you can give access, through cryptography to certain institutions or individuals. So let's say the FBI wants to see some piece of data. It's not fully mutually exclusive with having a 100% private environment. And I think for builders, you see builders being thrown in jail that do privacy work. I think it's important to have these compliance angles handled. All right, so let's talk about proof of encryption. So a lot of privacy solutions sit on top of a blockchain, okay? One of the issues is then, if you're an application, you show up and start using it, you can't use this unless you specifically integrate with this bespoke privacy solution. And it requires a lot of extra work, process, UX challenges, often a lot of latency because you're operating above the consensus layer. That's one of the biggest issues. Higher costs, performance and reliability issues, transactions failing. You're not at the level of consensus. And also, it just adds another arena for security vulnerabilities, okay? So we have the consensus that really is in charge of security, and then we have this other layer on top of it where a lot can happen, okay? It's just very complex. So what proof of encryption delivers is an integrated solution where blockchain is fully encrypted at the consensus level, okay? So the nodes, when they're actually validating transactions, aren't able to see information and take advantage of it and front run, sandwich attack. It also benefits the end user, which I talked about earlier. The thing that's nice about this that we're finding, we're in testnet now with this, public testnet. People are liking the fact you can just show up, deploy your EVM code, and take advantage of privacy and not have any MEV. So no performance issues, latency, reliability, failed transactions. It's the consensus completes, transactions finalized, so is the privacy, okay? It's out of the box, like I said, just deploy your EVM code, no additional costs. And again, you're just relying on those nodes and consensus as your primary security parameter, or as opposed to a completely adjacent product that is the intermediary between your users and their transactions. Okay, so how do we do this? So Byte protocol, something my co-founder, CTO, Stan Kladko, came up with. Stan was one of Dan Bonnet's students at Stanford and was on the founding team of a cryptography startup with him in the late 90s. He's a physicist as well. So you can see we have the BLS, which is Dan Bonnet's, one of his, he and some other people's invention is a core part of this. But Byte stands for blockchain encrypted threshold encryption. So BLS is a core component of this, and please take a look at it. Threshold cryptography. Also, we utilize trusted execution environments. So trusted execution environments are secure enclaves inside of each node. So the validator is running a node. However, the validator can't see everything because we're leveraging this secure, essentially partition component inside of that server to store confidential information. We also do some things with distributed key generation to help make this work. In a typical blockchain, the transaction goes right to the nodes. The nodes have the full list of transactions, and then that's where all the gamesmanships begin, being able to sort things, reorder things. There's really no way, unless you try to, like I said, with some add-on or intermediary solution, try to integrate confidentiality between the transaction and the node, there's really no way to keep things confidential or private. With Byte, you have a transaction. The transaction's then encrypted in advance. Then it goes to the node. The node then is ready to process the block. The node's able to still validate that, hey, all this information is accurate without seeing all the information and being able to manipulate the information. Then consensus happens, and then in Byte phase 1, the information is then unencrypted, it's decrypted, and you can still see all the information. If the barista test in that case wouldn't work because you can still see the information. Byte phase 2 has an option to actually keep the transaction fully encrypted and have configurable parameters so that you can determine what's private, what's not private, what set of things are private, and really let developers utilize blockchain in a way that meets their privacy goals. I'm not going to get into this today, but there's a lot of math here, a lot of process, again, using the ingredient parts that I mentioned earlier. We have a white paper and a light paper. If you're interested in reading it, you can go to fairchain.ai and check it out, or just go to follow SKALE. I'll show you later some links. All right, is this making sense? Okay, great. So let's talk about use cases. So when we look at the DeFi market, we feel like we're just scratching the surface, okay? What are the main things we do? We do automated market, AMMs, lending protocols. Those are a lion's share of the DeFi market, okay? But you talk to advanced builders, they want to do, leverage CLOB or limit and have, close limit order books and have limit orders. They want to be able to compete on par with centralized exchanges in a decentralized world. Well, if you have a limit order now, that's going to be completely taken advantage of, okay? You have this limit order, well, guess what? Every node sees that. You're going to get front run. On-chain indexes with rebalancing are something people want to do. So being able to have an index that is able to rebalance without getting constantly front run. And you think about how often an index needs to rebalance. And one of the challenges in a decentralized environment now is just you lose a ton of efficiency, all right? You lose, there's slippage. It's just hard to maintain a good economic advantage when you're constantly losing out to bots. Enterprises. So we talked to big enterprises, institutional traders. Well, guess what? They're not used to having MEV in their trading environments, and they're not used to having smaller set of functionality. Agentic AI. So talk to people doing agentic AI trading. And, the reality is you talk to a normal user and you say, hey, do you care about MEV? They don't care. I lose a few cents here and there, a few dollars here and there. But you talk to an AI builder who's like doing agentic DeFi, and instead of that one person doing 5 or 10 trades a month, that one person might be doing 5,000 or 10,000 trades a month, okay? Through their agent. But the cost of MEV, if you're losing X% each trade, it just goes up in aggregate as trading volume goes up. Also, we have people that want to put more advanced on-chain logic. So they want to have trading strategies that aren't just one trade, but has if, then, this. And if that information is all public, these strategies won't be able to operate. All right, again, we think MEV, there's a lot of different opinions here, but I think MEV, we feel like, does not add value. But it's not been something we've had an option to to work around in the past. So we think it breaks DeFi. We think it hurts agents, and it stifles innovation at the enterprise and institutional level. Oops. All right, got some clicker issues today. All right, so again, removing MEV from DeFi, enabling agentic AI at scale in DeFi, having advanced on-chain strategies, neobanks with privacy, B2B enablement, global payments with privacy. Think about all the payment use cases that will be more and more accessible with privacy. You think about compliant private trading, prediction markets that all of a sudden aren't being front run, that don't have to deal with MEV. And the last thing here is X402. So who heard the X402 talks earlier? Yeah, they were great, right? And I went to the happy hour last night. It was one of the best crypto happy hours I've been to in a long time, or just meetups in general. There's a lot of smart people, good conversation. There's a lot of energy in the X402 builder space right now. But I'll be really quick because I know a lot of you just heard very long presentations about this, but it's an internet native protocol for payments. It's leveraging the HTTP 402 status code. And it's kind of cool that this thing's just been sitting here dormant for X number of years. No one's really been using it. Like, hey, now's the time. Our team's been really active, in the open source community with X402. We've had a ton of pull requests across different platforms. We're building products, and we're building that because, one, we believe in it, but two, we also see a really strong fit with privacy. Here's our guys, our buddies, the baristas. Well, in the world of X402, you're going to have a lot of, robot baristas. They're not really going to be baristas, but these bots too, the use cases can benefit dramatically from privacy and confidentiality. When your bot's out paying and doing all these things, you really want that tracked back to your identity. In some instances, no, but in some instances, you don't really care. In many instances, you do. You do not want this information exposed. So we're working really hard to be able to bring this byte phase 2 privacy to agentic efforts with X402. All right. So, hey, it's been my pleasure. If anyone has any questions, we'd love to handle them. You can follow me there at X and SKALE and the Fair blockchain. And yeah, thank you.
By the way, Jack is sponsoring SKALE of the event, so I'm incredibly grateful for Jack and his crew at SKALE. They've been sponsors of my events going back to, I think, 2018. So I'm grateful for all your stuff. So one question, and then connecting.
By the way, round of applause for Ken. Come on. Okay, we got a question in the back.
Is that agnostic with AWS Nitro too for redundancy?
So in the short term, no, unfortunately. And I think there's also a big movement into TDX from SGX. There's just a lot of nuances with the smart contracts and the work we're doing with Solidity that is very specific to SGX. One nice thing is a lot of the issues with SGX, when you incorporate multi-party computation and blockchain dynamics, it's really, really difficult to actually have anywhere near real-world meaningful attack vector. But definitely something we're thinking about. And I know Google and a lot of the other providers have products, and I think a lot of it's moving into TDX, but we're just trying to ship this out, and then we'll get more configurability. Great question, though. Thanks. All right, everybody. Appreciate it. Thank you.
Great. Thank you, Jack. So we got a panel going up now. So Miko, Noah, and Gary, can you join us? Okay, great. So we're going to do a DeFi panel, and then we're going to do a break, and then we've got some breakout sessions. One of them is on confidential compute. So check that out. Join. Maybe you guys can all add to it. It's some really cool tech. Right? Yeah. Grab a chair. Yeah. Here you go. Why don't you guys sit under the sea? There's sit under your photo once we get it up here. I think it's Gary's here. Miko and Noah, but you have to check on it once we get it up. Think you're there. Shout out to the woman in the Detroit Tigers sweatshirt. How we doing? Tomorrow. It's tomorrow, right? What time? Where are we meeting at the bar to watch? 1:30, right? Detroit Tigers are in the playoffs, so baseball. Okay, great. So let's see. Let's introduce yourselves. Gary, you gave a talk. Let's do it again, though. I guess do we have? Yeah, there we go. Perfect. Yep, got it right. And we need microphones. Awesome.
Okay.
Great. Go ahead.
Right. My name is Gary. Good to see you again. And I'm a veteran investor for like 15 years from Web 1 to Web 3, and now doing CICADA, which is on-chain asset management.
Yeah, hi, I'm Miko with Gumi Cryptos Capital. Yes, we're currently deploying $110 million fund two, and we're pretty active. So, come see me if you raising.
Hi, I'm Noah from Upside, CEO and founder. And what Upside does is RWA trading and tokenization. So we do that, digital asset operating system for investment platforms.
So he's going to be doing a talk in about an hour on agents and
Deep dive, yeah.
Yeah, so check that out. Okay, so what I want to talk about is payment space. We'll talk about stablecoins. We'll talk banking and what's going to happen in the banking. We'll get a little geopolitical and macro here, and then we'll talk RWAs. Okay, so I want input on sort of the payment space. Where are we sort of like on the Gartner curve of that in terms of the hype? It sounds like it's amazing, but it also sounds a lot like a couple years ago with AI and everybody jumping into it. So give some perspective of opportunities and also, Miko, why don't you start?
Yeah, so with respect to payments, I feel like the big opportunity is essentially regulated stablecoin cross-border payments. And I feel like what we're seeing as a fund is we're really seeing that there is kind of a generational opportunity, and that the players are in market with product and they're growing. And in a way, like what we're seeing in terms of the up rounds that we're seeing in our portfolio is we are seeing bigger players that are sort of forced to pay. I think with respect to things like announced, like Pantera just announced leading a large one into CoinFlow, which is one of ours. And so I think the issue with this is that if the train is leaving the station, right, then you can always just pass and get the next train, right? Except for there is no next train, right? So what I mean to say is that like the companies that are succeeding, we have one called Zabio that's doing essentially like Colombia, US mostly corridor. And these guys are basically like 10xing the number of exchange houses they're working with, but the exchange houses month over month are like essentially doubling their volumes, right? So when you really look at the escape velocity of a lot of these cross-border payment companies, like the supply chain can't say no, meaning that the up round funders are coming in. They're coming in heavy because they know that if the train leaves the station, there's no next train. Like that's it. It's kind of like I don't know. It's like 1 a.m. It's like that's the last one, right? It's like if you're not on that train, like it's done. Like
so, you're saying TradFi is waking up and saying we gotta jump on this?
Yeah, there's definitely like major heavy,
Panic.
Yeah, and they just need to get their foot in the door, and so to organizations at scale like Series A is early stage, so it's fine.
Gary, do you want to include?
Of course. I just actually mentioned about the supply chain fight, right? I can give you some of the numbers. I've invested a company. It's a traditional Web2 supply chain company, and that is called DHgate. They're actually doing the main business between the Western and the Eastern. And actually in 2022, their settlement by USDT and USDC by crypto actually is less than 1%. And I talked to CEO, we have to build up some related to crypto settlements. And that because the growth curve is very apparent. And then she said that, okay, this is not legal in Asia and mostly in Asian countries. So I'm not do that. And later on, 2023, the number goes to 1%. And 2024 is 5%. And this year going to be more than 15%. And you can see that the exponential model is very apparent. And I mean that in the States, state is the innovator, is the pioneer. But actually, you can see that many of the payment settlements in the world actually change quite a lot. In Nigeria, you know that Nigeria population is 223 million. And more than 65% of the people actually use the crypto as a settlement every day. So that is a big number. And you can see that most of the African country actually use USDT or stable coins to make the settlement. And the growth curve is so exponential. And you can believe that in the next, not 5 years, but 2 years, actually will substitute the traditional financial system. And the same thing will happen in Bangladesh, South Asia, and Bangladesh and India, and also happening in Latin America, in Argentina, and also Brazil, part of the Brazil, south part of Brazil, and it's very, very apparent. So why supply chain fire? Because most of the settlement actually has been substituted by the crypto payment, and the trend is very apparent. So go back to the question and say that what is the point for the Gartner curve, right? The Gartner curve actually have got two curve over there. One peak actually is for the narrative. And we have already gone through for that. And then after the peak, then it's disappointment. And then go up again, which is the second growth curve, what I mentioned. It's definitely the second growth curve. And there's a lot of payment by that, yeah.
I want to kind of say this, and before handing it over, which is that when you look at the Gartner curve, there's this thing called the slope of enlightenment, right? So the thing that happens in the original hype cycle is that there's an asymptote up, right? And then that asymptotes towards the vertical, and then it inflects, right? Goes over, right? And then the trough of disillusionment, and then you have this kind of asymptote towards the horizontal, which is the slope of enlightenment. I don't think that's what's real, right? This isn't a Gartner thing at all. Like, Gartner doesn't apply. This is really just this, and we're on the leg up, and it's real, right? And the reason it's real is because it's open source software. Like, it's not some speculative thing. It's regulated, and it's real, and it's happening.
So
and
it's a phase shift now.
Yeah.
We really entered it where it's now going digital and there's no turning
And the
back.
trigger is regulation, which is why it's not, there's no, like, here's the funny part, right? Which is there's a bunch of companies that are like, oh, enterprise payments. And it's like, oh, I have these pilots going on in enterprise. Bye-bye. Like, that's useless. Like, you're wasting your time. Like, the people who are going to win are in the market with product, customers, revenue. Bank pilots, you're late, it's over. You're going to waste all your money and nothing's going to come out.
Give me a minute or two, we'll go into stablecoins.
Yeah, absolutely. So I think that, thinking about the Gartner curve, generally, we could be talking about blockchain, which is a big word. We could be talking about stablecoin. We could be talking about a number of other trends within crypto. And I think maybe early on, there was a sense that the Gartner curve was for blockchain in total. And now I think we've got more of like some fast Fourier transform going on or something. We're breaking out all the different components of the curve. So for example, when I see all the stablecoins coming online, I think, oh, that's buy side for all of the RWAs that will be coming on later. But that's a different curve. And we're in kind of a different phase for that cycle as well. Right now, the energy is around stablecoins, but it's the precursor event, in my view, to a lot more buy side.
Right. So it's essentially when you look at Web 1, Web 2, Web 3, Web 1, we had information online and it was boom. And then you had user-generated content. You had phones, you had Wi-Fi networks, you had the ability to upload really quickly. So we got this huge amount of media from users, and that was our Web 2 explosion of user-generated content. Now we've got money as a digital primitive, and we're going to have many other things related to it. But when that happens, we've got this complete transformation of economic systems because of the digital primitive of currency on chain.
Yeah, just the last comment is that, USDT is the buy side for Bitcoin, and that's what allowed the rise of Bitcoin was the existence of USDT. Now we have a lot more assets, but we're going to have, more dollars chasing those assets as they come in from stablecoins. And we have the built-in AML KYC mostly around those currencies. that solves a lot of problems in some of the other spaces.
Yeah, stablecoins are the gateway drug.
Yeah, so let's talk stablecoin. So we've got, obviously we've got the ones preeminent now, but we're seeing many, many more. We're seeing, as Matthew explained, a lot. What is that sustainable? Are we going to see, Walmart stablecoin, Apple stablecoin, X stablecoin? Are we going to see everybody doing? And then not only are they USD, but are we seeing other currencies? What happens with all these stable coins? Who wins? Who loses? Are they going to be major flameouts? Is a major brand going to get hacked and have their stable coin? What's going to happen with this flood of stable coins? Why don't you start?
Right. I give a metaphor for stablecoin. I mean that this USDT and or other US related stablecoin actually is no longer the US dollar. Actually, it's not inside the trial balance at all. It's really, the metaphor is really similar to 2 centuries ago about English. Singapore speak English, Indians speak English, but that English is not England, British, or the official English. It's a new English that's related to the history, but actually it's independent English. And the stablecoin is very similar. You can print stablecoin on blockchain, but that stablecoin actually related to the original federal US dollar, but it's no longer being controlled by the details. Still will be affected by the fiscal and the currency policy, or indirectly influenced by that. But it's related. It's really similar to English. I mean, that is independent and have got a cohesion together, but actually it's independent. And this is very important. And why US dollar? Because in the traditional finance, in the last 1 century, US dollar have won the most consensus in the world in Web 2, in traditional finance. And so that everyone will use that by heritage. I mean, that's use US dollar, not other currencies. But the new US dollar related to stablecoin is actually, you can say that it's shadow money. You can say that it's the new version of US dollar, but actually that is no direct connection with federal. It's a new version. So that is why it's similar to the English.
I'm very excited about that perspective. I think travelers in Singapore will hear Singlish, so they'll hear a very unique kind of owned mechanism. But I think the thing that's ironic is that when you really look at this arc of the English language, right? The irony is that English has become the lingua franca for the world, right? Which is originally supposed to be French, right? But I guess what I'm arguing around what you were saying about this kind of ubiquitization of US dollar, you use the word that I really love, which is consensus, right? Because when you look at Ray Dalio, like Ray Dalio has come up to the line of being a Bitcoiner, right? Ray Dalio, Bridgewater, has really been talking about, so the new phrase that Dalio uses now is he uses the phrase non-fiat currencies. That's what he says now, right? So it's amazing because he's right at the lip. And when you look at non-fiat currencies, the precedent is actually gold. But I actually have a different phrase, which is I don't like non-fiat currency. I actually like the idea of consensus currency, right? Which is that it's not backed by a monopoly of violence over territory, right? It's basically like, if you like Bitcoins, buy some. If you hate Bitcoins, don't buy any, right? So it's a consent currency, right? So when you say the US dollar has consensus, the thing you're talking about the transformation of the US dollar from a fiat currency into a consensus currency, in the sense that the power of the dollar is because it has liquidity. Why does it have liquidity? Because people agree. What is agreement? Agreement is protocol. It's consensus. It's consent. So it's an open source thing. So that's what I think.
Noah, so question is twofold. One, US dollar hegemony, but the other aspect is with all the stable coins coming out, large brands, tech companies, banks, retailers, et cetera. Is there a market for them? What happens with what's your view on what happens with stable coins, both with the multitude of stable coins coming out as well as with USD versus other forms of
So let me take a quick whack at that, right? Which is that so Amazon's going to do a stable coin. And to me, any provider of a service ought to launch a stable coin. And the reason they ought to do so is simple, which is that they can claw back the float, right? So the thing that's crazy is when you look at the Amazon business. So there's two businesses, one of which is that they're paying transaction fees to the people that provide the rails, right? So they can just claw all that back. So now they're like already rich. Amazon gets already richer because it's our rails, right? But the second thing that happens is they can actually claw back the float. Like if you look at a service like AWS, it's basically like, if you just want to use Amazon dollars, right, then we'll just give you a 5% discount. What happens? A net 30 float claws back to the provider, right? So like to me, like, is everybody going to do this? They are going to do this. Like everyone's gonna do this, right? And you know, so I think it has to happen. Now, will they get hacked? Yeah, they'll probably get hacked too. But like, you know, but everyone will do it. So I'm on that.
I think, you know, stablecoins are more subject to regulations than crypto, but they're not permissionless assets. And so there's going to be a lot more geopolitical black swans. So you probably will not see like US dollar stablecoins being used extensively inside of Russia, for example. You won't see it, you know, the more the world kind of divides into these geopolitical clusters, the more the regulatory part is going to matter. So that's one factor. The other factor about why I think the innovation curve could actually go on for a lot longer is that a lot of there's a lot of innovations that haven't occurred yet inside of stablecoins. So around composability, programmability, all of the things that are native to DeFi that are layered on top of that. And so I could see some additional breakouts later. But I guess the question of who wins in these spaces largely comes down to distribution. And so there are probably a lot. I mean, Stripe's stablecoin initiative is super interesting because they're already located at the location of payment. So they have kind of a built-in access to all of the rails, all the payment, et cetera. I mean, where that's occurring. So I think those kinds of advantages are important differentiators, but I don't think the game is over. And I'll say the black swans are going to come from geopolitical aspects.
Okay, so real quick lightning round. I guess this is because we're coming up in the break. So real world assets. Give me your top like 3 that are going to break out sort of soonest in terms of real world assets. So Gary.
For real world asset, actually, if you want to tokenize it, actually tokenize is very simple, but liquid is very difficult. So if you want to tokenize an RWA, it's very important whether you have got a consensus for liquidity, and their liquidity decide the marketplace, and then marketplace rate works. So you cannot just image there's only OTC for that. Actually, it's a one-on-one. Actually, it's case by case. So according to me, it's a liquid asset, mature asset. So for us, actually, we're doing the business for RWA. The first one is a quant strategy quant strategy RWA. The second one is loan related, loan fi. Third one is a supply chain. I want to mention one of the supply chain, and actually it's related to stablecoin. Stablecoin, actually, many people think that it's a currency, but actually it's not. And their stablecoin are different from each other. So before the currency, if there is no enough consensus, then it is voucher, it's certificate, it's a kind of acceptance of bill. Whether we call it acceptance of a bill because it's only accepted by some of the people, not all of the people. If an asset can accept it by all of the people, then it's currency. If some of the asset accepted by some of the people, it's called acceptance of bill or letter of credit. And if there is nobody actually accept this kind of asset, then there's accounting. So many of the stablecoin now is only accounting. After the accounting is accurate, then can put into the second stage, which is acceptable bill or certificate, and then to stablecoin. So stablecoin are different from others, and also similar to RWA. If there is no consensus at all, and then this kind of RWA is still real world asset, but not related to Web3 and crypto.
So what were your 3 years? Quant
Fund strategy, and which is similar to Ecina.
loans.
Loan fi, loans.
And then what was the third?
Supply chain acceptance of bill.
Supply chain asset.
Yeah, supply chain asset.
Okay, awesome. Very cool. Miko.
Yeah, I mean, I think on a similar note, I would say also loans. I would also say that when you look at loans, you can also look at things like receivables, right? So those are logical constructs, very similar actually to trade finance and supply chain. One of the ones that's a dark horse for me is actually compute. I feel like compute has an opportunity to create a broad derivatives market as a commodity. So I think there's some really interesting dynamics around compute. I do think that redemption on compute is actually non-trivial. So I feel like treating compute as I mean, even agricultural commodities are multiple dimension these days, like things like organic or non-GMO or like whatever, right? But like when you really look at like a commodity like compute, it isn't a commodity, right? In the sense of like, there's so many dimensions around it. But really, when you think about things like forward purchase of contracts for compute, like that's the game right now, right? Which is, you're seeing $100 billion exchanging hands, the same 100 billion exchanging multiple hands on forward compute contracts, right? But like that presages things like the rise of energy prices, right? So you're really seeing a lot of financialization there. So I feel like that's logical.
Yeah, that makes sense. Thank you for putting that perspective. Noah.
Great. Yeah. So I think for RWAs, there's kind of two ways we measure them. One is the total value of the asset, and the other is how many transactions are occurring. This is very similar to the way that different blockchains look at it. And I would say that it's largely driven by the liquidity aspect. So, for example, there's a lot of S&P 500 tokens right now, and there are no market makers for them. Likewise, the BuildETH fund tokenizes the most liquid asset in history, is like treasuries, and it is one of the least liquid assets on chain. So clearly there's something that's different about the public markets right now than about blockchain markets. So I think this all comes down to a liquidity question, and that'll be the entire subject of my talk at 3:55 p.m. And I'm also very interested in tokenized trading strategies as well. I think this is an area actually that intersects with the liquidity problem. Because a lot of questions about market making are driven either by AMMs for DEXs or by the choices of market makers. And there's actually a space around automated trading that can define the question of what's liquid on chain.
Awesome. Thank you. Reminds me of in the graduate way back when it was, plastics was this thing. Now it seems it's either DATS, X402,
Nice,
or liquidity. So I guess if you want to sound intelligent at a cocktail party, what's your liquidity strategy? Or what are you doing in X402? So anyways, thank you I wish I had 10, 20 more minutes to talk to you. Thank you. We've got some break food out there. Enjoy. Then we got some breakouts at the top of the hour. So 3:00, you can check the different rooms for the breakouts. Thank you, gentlemen. Really appreciate it. And enjoy the break, and we'll see you in a bit.
all right, I'll see you out there. Thank you.
Oh, yes. Oh, gosh, burner wallets. So yes, Brent, thank you for reminding me. Brent, here. I'm gonna give it the mic.
Yeah, I'll make it quick. This wasn't on the formal agenda, but it's nice to see everybody. I'm Brent. Thank you. Thank the panel as well. Thank you, guys.
Handout.
Yeah, so I'll just make this real quick. I'm Brent from Burner. Burner is a new type of hardware security wallet. Just a quick, Simon Says, who in the crowd uses crypto regularly? Maybe you send, maybe you swap, maybe you store stablecoins. Wow, what are the rest of you doing here if you don't even use crypto? But okay, keep your hands up. And now keep your hands up if you do all of those things, but use a hardware wallet. So put your hands down if you only use a software wallet, basically. Okay, this is pretty good. For those of you who put your hands down, why don't you use a hardware wallet? Shout something out. Why use it? Okay. Why don't you? For those who put their hands down, why don't you use the hardware wallet when you do, your transactions? Use the dApp, save your crypto. So I'll just kind of fill in the question. Basically, people say, it's too hard to use, it's cumbersome. If you ever use a Ledger or Trezor, you're sitting there trying to type those little pins while you're waiting for your transaction. We're seeing like maybe you're trying to trade something and the price is volatile and going up. So it's not very convenient. So Burner Wallet basically is a new type of hardware wallet. It looks like this, and it comes in kind of like a Pokemon pack. It's got like six different colors. There's a version for Bitcoin as well with one color. And I like to think of this as a kind of combination of a software wallet and a hardware wallet. It's got the convenience of a software wallet, but the security of a hardware wallet. As you can see, it's very different from the traditional hardware wallets. One, it's very colorful. It also actually fits in your wallet. And the big difference here is that unlike the traditional hardware wallets, this is much easier to use. We're targeting the use cases of gifting as well as everyday crypto use. It self-generates a private key. Everybody here will get a free burner wallet. So next time the question is asked, you will all say, yes, we use everything with a burner, with a hardware wallet. Self-generates a private key. You'll see that through a quick onboarding process. And unlike traditional hardware wallets where there's a concept of a seed phrase, Burner doesn't have one. We use PIN codes to basically secure your crypto. And there's some trade-offs there. You can come talk to me about them. But we believe that the less complex we make the hardware wallet, the use of a hardware wallet, the more people will start to use it every day in their lives. Let's see. Currently, we support Ethereum, Base. We just launched support for Optimism and Arbitrum. More L2s to come. And again, I mentioned it's also on Bitcoin. And yeah, you can do everything you can with a traditional hardware wallet. There's no app to install, which is another killer feature. Everything is on a web app. So all you have to do, it's an NFC-enabled card. So you just tap the card to your phone or your smart device. And essentially, Burner OS, our wallet app, comes out. And within that app, again, you'll see it all today once you onboard. Once you get into Burner OS, you can transfer crypto because there's a private key that gets generated. You'll even get an ENS, a free Burner ENS vanity URL. And yeah, you can swap directly as well within the wallet. You can send crypto to other people, and you can interact with dApps through Wallet Connect. So yeah, again, full-fledged wallet. And last thing I'll mention is, if you've ever tried to buy a Ledger, Trezor, I don't know what the floor is. I think it's about like $60 maybe on sale for a Trezor, and Ledger is a little bit higher, and they go up to a couple $100. MSRP on the Burner wallet is $19. We're actually selling it on the website burner.pro for $9 right now on sale, both for the Bitcoin and Ethereum versions. So it's orders of magnitude cheaper, and we really just want to make sure that everybody is secure as we all use crypto in our daily lives. I'm going to be setting up here somewhere. Yeah, as long as I'm disrupting. Yeah, I'll be here. I'll be here for a while, so no rush if you want to go use. Yeah. Yeah. So essentially, I'm going to give you one of these for free, and you're going to tap it to your phone when you have a chance. Quick onboarding process. You'll self-generate a private key. You'll be asked to create a PIN code. Make sure you're hiding it a little bit, because if somebody does get does find your card and knows your PIN code, then they will be able to access any crypto on it. So you do want to keep it, protected. There's also a duplication feature for those of you wondering, like, what happens if I lose my Burner wallet? Again, they're so affordable that if you're going to be keeping at least some amount of, substantial money on it, we always recommend getting a second Burner and then making a duplicate. So other than that, if there's any other questions, I'll be here. I'd love to chat with you, especially if you onboard. I'd love to get your feedback on what the experience is like. Thank you very much.
So what's the website again?
Burner.pro, P-R-O.
All right, tell your friends. Burner.pro, he'll be setting out there. And meanwhile, grab some breaks. And then here's the breakouts. So, oh, sorry, no, next one. Go to the next. Wait, no, sorry. Yes, it is. That should be 3 p.m. That should be, instead of 11 a.m., it should be 3 p.m. So these are the ones in the afternoon. Find them and join. All right, we'll see you in a bit. Thank you.
Essentially